Views expressed are solely those of the speakers and do not represent this show or its team.
If you can't explain it, don't buy it. And that kept us from buying a lot of awful things that other companies were buying. Call me old-fashioned, Wade. I believe in that old adage, know what you own. There's a lot of tailwinds for the economy. There's a lot of tailwinds for corporate profits. And it's hard to imagine a scenario where stocks go down when corporate profits are going up.
Welcome back to Built to Last, conversations about wealth, work, and life. Gary, we're going to jump right into part 2. We got a little winded on the last one, but a lot of good information. And I'll be honest with you, time went by really fast for me.
Once you get me started, Wade, it's hard for me to stop. I just love this stuff so much. I guess can't keep my mouth shut.
Well, we'll keep it going here. We'll keep it flowing. So let's dive right in. I'm sure by now you've got an asset class for digital coins, right? So what is it? And explain it to me, because last time all I heard was it was something that nobody knew how to define where it's supposed to fall. Is that where we're at still?
I think that's where I am still. I still have no idea why Bitcoin exists or what its utility is or how it's supposed to, revolutionize finance. I don't get it.
Yes.
I guess that's one way to put it. I don't get it. And I guess that goes for all the other, coins that are out there as well for me.
Right.
And I go back to, and maybe this is wrong now. Maybe I need to go back and ask the question again. But I used to ask companies all the time, CFOs at companies, how are you using, tokenization in your business?
Well,
how are you using blockchain?
But before you talk about that, I need to. So what about that? Just happened. The New York Stock Exchange just announced they're tokenizing. I mean, so how do you feel about that? Because that's kind of where I was going to head you down, put you in that rabbit hole. Because I mean, are we at a point where we have to figure this out? I mean, I think it's getting close.
I don't know, and I probably need to do a little bit more research on that particular aspect of it.
Mm-hmm.
There's definitely a lot more gamification of the markets,
right?
Which I don't think is particularly healthy, because it's not a game,
right?
When you lose all your money, you lose all your money.
Yeah, but that
just
I think
ones
that
and zeros.
I think that has a little bit to do with certainly. I'm going to call it digital coins, whatever you want to call it. I don't want to use a paraphrase like Bitcoin, because that is just one of those digital assets, right? So, but let's talk about crypto, and let's talk about the things that we're seeing. Again, New York Stock Exchange, supposedly, I think I read integrated in 30 days or something. That's pretty big, because that capital moves immediately, right? That change that there's a lot of leverage that gets removed in that process, in my view. And how do you see it?
I guess if it is a way to reduce transaction costs,
mm-hmm.
and a way to reduce friction in the
mm-hmm.
system, that's an economic good.
And that's what they're touting, right?
Economic good.
From the beginning, that's what they're touting. But what are the downsides too?
I don't know enough about it to know exactly what the downsides might be. But I think as long as there's a paper trail, not necessarily a paper trail, but there's the ability to reconcile where these transactions originate and where they're going. I think that's fine.
Right. Because there's always bad actors.
If we get to the point where it's too anonymized, then we don't have controls in place to ensure that bad actors aren't
I agree.
involved in it.
I agree. I think it's exciting. I mean, digital assets is a growing class, so to speak. And I think Obviously, my crypto experience has been somewhat limited. I buy it. I look at it as a long-term, hold, and don't really have a reason that I'm doing it other than it's another, it's something that I can use when I need to. And I've purchased some things. It's become more easy to trade and do things, purchasing or doing some of the things I enjoy. That being said, I don't know that it's a hedge against anything. I don't know. I have to agree with you. I don't know what class it would be other than it's something. And I think at some point we'll have some kind of description for it. But right now it's just another very volatile asset that seems to continually climb over time like other good assets would do. So I don't know that I would put an asset class line around it of where it falls, other than to say it's just another piece of diversification is how I personally use it. I don't know. Do you personally invest in crypto?
I don't.
Okay.
I don't.
Well, we got to get you started, Gary,
I call me old fashioned, Wade. I believe in that old adage, know what you own. And
I got you.
Something that kept us and my former life, former company out of trouble during the great financial crisis was, if you can't explain it, don't buy it.
That's
that kept us from buying a lot of awful things that other companies were buying.
Yep.
Credit, all kinds of structured investment products that had liquidity lockups, and people didn't know. People didn't know what they were really buying.
Yeah.
And it's something that, for me personally and for our clients, if I can't explain it, I don't feel comfortable owning it.
I agree. And I'm certainly not trying to promote any of our clients. We just, we get a lot of questions about it. And that's kind of what I say is we can't define it. So we can't, in any way, form or fashion, suggest that you purchase it. But if you're going to purchase it, I can tell you what it's like and tell them the story, how easy it is to do it. But, the cautionary tale is we're not really giving advice around it.
Yeah, I think the other thing is that, there may be people out there who are much more knowledgeable about cryptocurrencies than I am. And so they may have a better framework for understanding it, for understanding valuation and for utility. And so they feel more comfortable in that. Or they may just be higher on the risk tolerance than I am. And so they're okay to speculate in things like that.
Well, I got.
There's a place for both of those.
I'm not cheating on you. I don't want you to think I'm cheating on you, but I do like Coinbase's leadership as well, and I think they've been an exemplary organization to use. And I think they got great leadership there, much like the leadership you provide all our clients. So I don't want you to think I'm cheating on you, okay? But I think they're a good company to start with if you're looking at the crypto world. Now, that being said, I want to talk a little bit about, I don't want to get in the government oversight of crypto. I just want to let's talk about some good things I'm seeing, and I feel like, is that, we had a very long government shutdown, and it really didn't have the impact that a lot of people thought it was going to have. You want to talk about that and then talk about where we are now, where we were a year ago to where we are as far as like how we have seen debt come down and we're really starting to see GDP move.
I think we may be on the precipice of another government shutdown here shortly if Congress can't pass these spending bills again, that they gave themselves some time to do it.
Yep.
The issue.
Well, Congress, I think it just, it's got to clear the Senate now, right? And there's who knows what leverage is going to be held there. So I agree.
And it seems to be around the same issue that it was last time.
Yep.
Whether that gets how that gets dealt with, I'm not sure. But it's an election year, so people will want to. They'll want to pass something so they can go home and start, campaigning again. But the government shutdowns rarely have more than a, quick impact on markets, and they certainly have a larger impact, here in the DC area where I'm located, because people are out of work for a little while, and if it goes on too long, they start missing paychecks, which impacts local businesses and the ability for people to pay for things. So there's a lot of angst around that. Outside the Beltway, I'm not sure that that the rest of the country or the rest of the economy really feels much in a government shutdown.
Yeah, I had to say it didn't feel like outside the Beltway. It didn't feel like core economics really were impacted that much.
I mean, the biggest thing that was for me that selfishly that we didn't get government data.
Yeah.
So for those who lived and died by economic releases, we were sort of flying blind for a little bit.
Right.
But again, that's where we get back to this, signal versus the noise.
Yep. Exactly.
That was going to be noise. What happens in a 2-month period or a 3-month period, and all of the government data is backward looking anyway, so it already happened. So we shouldn't be making forecasts based upon that anyway. But missing some of that data was important for talking about where policy rates should go in the future.
Yeah, and I think you did a great job of staying focused, helping us stay focused. And I think let's talk a little bit about why the process matters more, right? Like, you have a process and you stick to that process, and you may not have the data short term, but you're certainly looking more than, long term. So walk me through that.
So our process, I guess, starts with, where we started this conversation. What's the direction of interest rates? Because all financial assets are going to be impacted by the direction of interest rates. We look at GDP growth and where the fiscal stimulus is going to come from in any given year, or lack of fiscal stimulus.
Yeah, exactly.
Yeah. And generally make a decision upon what the economy is going to look like in this country and other countries based upon that. And then we look at valuation. Where are things? And again, as we entered 2026, we seem to be right back where we were at the end of 2025, which is U.S. valuations were high, and the dollar had recovered a little bit of what it lost, but was probably still going to decline. So, our process is the same, looking at that top-down approach, and then a bottoms-up, looking at sectors, which sectors are likely to perform, outperform, underperform. And frankly, I went back to change our slide that we put in client portfolio proposals, and didn't have a ton of things to change in it.
Yeah.
That the beginning of 2026 looks a whole lot like what we thought 2025 was going to look like, and 2025 played out pretty close to what we thought it was going to play out as. I think, if anything, 2026 has this feeling to me that with the stimulus from the One Big Beautiful Bill Act, both on the personal side in terms of individuals and individual taxpayers getting more in their take-home pay and getting probably a decent-sized refund in March and April, and then businesses getting all these incentives to do capital expenditures, which we know filter down to the rest of the economy too.
Right.
That GDP is probably going to be higher in 2026 than it was in 2025, and in 2025 we had really good growth.
Yeah.
So it's hard to imagine in a scenario like that, where we have 3 to 4% GDP growth, and mild inflation, 3%, call it.
Yeah.
It's hard to imagine that the economy gets into real trouble with a 6 to 7% nominal growth rate for the year.
Yeah.
And
exactly.
barring anything, barring any, crisis, real crisis that comes up.
A real crisis.
A real crisis.
Yeah.
And I saw Scott Bessent talking at Davos, and the real crisis that he imagined, the one that keeps him up at night, is China invading Taiwan.
Exactly.
I mean, that would be a crisis.
Yep.
Trump asking Europe to let us have more of Greenland, to do the things that they want to do anyway.
Yep.
That's not a crisis. So I think we need to redefine the word crisis back to what it used to be defined as. Yeah.
Yeah. And I think the only, it depends on if you can just be out of politics and you think about us as a country and you think about, protecting hemispheres, that we're already there. We're already doing it. It just makes sense to me from throwing politics aside. Now, that being said, we talked about companies feel confident. I don't get the same. Where are we with consumer sentiment right now?
So consumer sentiment is still struggling, and it's still bifurcated a little bit when you delve into the numbers, by Democrats versus Republicans. Democrats feel worse about the economy than Republicans, but it's not like the average overall is trending bullish. And one of the things that I've noted and kept track of is a chart that shows real consumer incomes versus inflation,
right?
And then subtracts out transfer payments from the government, Social Security, Medicare, welfare payments, that kind of stuff.
Right.
Takes out transfer payments. And the reason that consumers don't feel good is that inflation buildup that we had in over the previous 5 years, has really eroded purchasing power.
Yes.
And even though inflation is slowing back down to below 3%.
Yes.
It doesn't mean that the price of milk goes down.
Right.
It doesn't mean that prices go down, which is what I think people want. I think in consumer sentiment is reliant upon this idea that, 5 years ago, cars cost this, and today they cost this plus.
Right.
And it's expensive to live, and it's not going to get less expensive. And you see this line of incomes excluding transfer payments converge on the inflation rate over this time series. And you see people you can see it in the data that people are struggling to keep up with inflation. And that's why
when they come in the door, Gary, you can tell when you're meeting with the younger advisor or younger client, that spread has just narrowed, and it's certainly something that we have to take into planning expectations. And I would also, we haven't even touched on the housing market, right? The housing market is I don't want to say it's upside down right now, but I certainly think it's sideways. I think that, in some of the things that I'm closely aligned with, we're sitting on an inventory, and I'm hoping that something happens in the near future with that.
Yeah, I tend to be an optimist around things. And so let me just say that, that the effects of tax policy and capital spending policy are going, especially in a scenario where there is a shortage of labor, is going to put pressure on real wages to rise.
Right. Exactly.
And that's what we saw in the first Trump administration too. In years 2 and 3 before the pandemic, we saw real wages for the bottom, half of workers rise at the fastest clip since the 80s. And I wouldn't be surprised if we don't see that again. And that could turn consumer sentiment around. It doesn't happen overnight, but over the course of the year, it's possible that we'll see real wages start to rise, and people will feel better about that. I certainly think that's what the Republicans are hoping for going into the midterms, which is why they're trying to juice the economy here. Yeah. But I don't think it has an a huge inflationary impact. Which and the reason is we did it before in the first Trump term, and we didn't have huge inflation. And the reason is the government isn't printing money and handing it out to people.
Right. Yep.
They're reducing taxes and giving people their own money back. Yeah. And I think that's a big difference. And we don't have a gigantic.
It's okay to say a gigantic difference, and we could do a whole podcast on that. But anyway, moving forward, go ahead.
Yeah, I think that inflation is everywhere and always a monetary phenomenon.
Right.
And if you don't have a lot of money printing, which I don't think we're going to see,
right,
then it's hard to imagine that it's super inflationary.
Well, let me move you down the road a little bit. We're starting to run out of time. Let's talk about your wall of worry. So what do you see immediately that you're thinking about? I know how you guys work, and you have a wall. And what is it right now?
I don't really have a wall of worry, Wade. The wall of worry is just out there. It's something that fills magazines and stuff like that. I think what I have are a variety of risk scenarios that I can apply probabilities to and then have solutions from an investment perspective. What would I do if X happened? What would I do if Y happened? I think the biggest thing, if you're asking me what's at the top of that wall of worry, it would probably be the same thing that Scott Besson talked about this past week in Davos, which is, according to him, something like 97% of all the world's top semiconductors come from one place, Taiwan. Right. And as he called it, it's a single point of failure. If China invades Taiwan, that is a huge issue for the global economy. We saw during COVID what happens when we reduce the amount of chips coming out, and we can't produce cars, and we can't produce consumer goods and things like that, and you can't get a new computer for a little bit. It would be a much bigger deal because now you're not only can you not get the semiconductors, but you also probably have a hot war in Asia on your hands. That would definitely drive down stock prices. It would probably be great for long-term treasury investors, but I still happen to have sort of put that one at a very low probability event, just because I don't think it's in anyone's best interest to actually do that. And so it's sort of low on my probability, list wall of worry. Okay. Things that are out there that are more worrisome to me would be we get inflation resurgency. That's one. Again, it wasn't my base case, but in that case, you might see an inability of the Fed to continue to lower rates for the rest of the year, which would definitely, as we talked about, from an interest rates versus asset valuation standpoint, that would have a material impact on how people would value financial assets across the board. So a resurgence in inflation would be on the list, and I think it's on everyone's list. But again, I think that the general trend is for lower inflation in the U.S. Those are the two big things I think that would be on the wall of worry for us.
So I personally feel very optimistic about where we are from looking at the market, even though we're valuations, like you said, 25 is repeating 26, but it seems like there's a lot of good things on the horizon. So from an advisory standpoint, sometimes, we have to remove our own personal exuberance, right? We got to stay in the system. But how do you feel right now? It seems like, what if you're looking at it from, if you're having to, look in your crystal ball, like I put you on the spot, where you see us being, let's just use S&P on December 31st of 2026.
I think the S&P is probably up 10 to 12% this year.
Okay.
I think that's a fair baseline.
Mm-hmm.
And a lot of that I think comes from a broadening out of, sectors that have not experienced a huge amount of increases in.
Talk about those sectors.
Industrials. I think the consumer, if we get an increase in real wages, some of those consumer sectors start to pick up. Consumer staples, I think, are a great place.
Right.
That can benefit from, real wage increases. I think a lot of those, even smaller companies, we've seen small companies start to outperform, but it's been this, at the beginning or the end of last year, it was really the speculative, small companies that, that don't really earn any money.
Right.
I think small companies that do make profits could see their stocks start to rise.
Excellent.
The other thing why I can be a little more exuberant about the stock market is because I still think there is plenty of pessimism out there, that we're not at a euphoric stage. If you look at investor sentiment, if you look at bulls versus bears, you look at all these traditional metrics of, where people are invested, you can see that, there's still skepticism. And I think that as long as there's a healthy skepticism out there, then stocks can go up. When everybody has decided that the only thing to do is to be at the riskiest end of the risk spectrum.
Right.
That's when it's time to, let's back off.
Yeah, I got you. I agree.
And I just don't think we're there yet. Yeah. So there's a lot of tailwinds for the economy. There's a lot of tailwinds for corporate profits. And it's hard to imagine a scenario where stocks go down when corporate profits are going up.
I agree with that statement. And I truly appreciate I'm staying within a system, right? Diversifying, continuing doing what you're doing. And you've done an excellent job leading us down that path. So let's end this for our listeners. What's the one or two closing remarks you want them to take away from this discussion? We don't do our forecast anymore, but we've obviously talked a lot about forecasting. What do you want them to take away that would be meaningful or impactful for them in 2026?
I think the things that I would take away from it are, one, don't be afraid to keep your current allocation. Don't get scared and try to de-risk unnecessarily. Yep. Two, international diversification is back. It has value. It will continue to have value for a considerable period of time because these trends are long, right? The dollar doesn't just reverse itself for 1 year. It's a trends in currencies, trends in international diversification are longer term in nature. And so international diversification is here and it has a benefit. And then finally, I think, if we're right that short-term interest rates go down and longer-term interest rates go up, then shorter duration bond portfolios are going to do well. And it's also going to be indicative of a healthy economy where banks are going to want to lend and GDP is going to grow.
That's
so
awesome.
those are the three things.
Yeah, very, very, very good three things when you're looking at it from an optimistic standpoint. So I'm going to say you feel, even though you won't say you're exuberant, I feel a little bit of exuberance there.
I'm never exuberant. It's just an even keeled kind of guy.
Yeah. That's why we call you Barry Manilow now. So, or Gary Manilow. So, but yeah, Gary, I appreciate your time again, and look forward to our next conversation. And I think hopefully next time we check in, we're on the path where you believe we're going to be.
Thanks, Wade. And I got the mission loud and clear to write the theme song for this podcast. So
there you go. I'm on it. Gary Manilow, thank you very much. Thanks for spending time with us today on Built to Last. If today's conversation helped bring clarity to your thinking around wealth, work, or life, that's exactly why we do this. Till next time, stay focused on building something that truly lasts.
This podcast is produced by Concord Wealth Partners, LLC, an investment advisor registered with the Securities and Exchange Commission. Registration does not imply a certain level of skill or training. The information presented is for educational and informational purposes only and should not be construed as personalized investment, financial, tax, or legal advice. Nothing discussed should be considered a solicitation or offer to buy or sell any security or investment product. All investing involves risk, including the potential loss of principal. Past performance is not a guarantee of future results. Individual results will vary based on personal financial circumstances, risk tolerance, and other factors. Concord Wealth Partners does not provide tax or accounting services. Tax and accounting services are offered through Concord Business and Tax Advisory, an affiliated CPA firm. For more information about Concord Wealth Partners, including our Form ADV Part 2A and Form CRS, please visit concordwealthpartners.com or contact us at 800-838-4370.